Okay, good morning, ladies and gentlemen, and welcome to MACROACE with your host, Tony. I am also the head financial analyst at FinancialJuice. So let's get into it. We've got about less than 15 minutes till we get the data, but also at the top of the hour, we get the US revisions to CPI, seasonal revisions as well. So we also have that to bear in mind for risk for the US. But let's get into the Canadian stuff straight away. So first of all, employment change measures the change in new jobs being added, including both full-time and part-time workers. And then you have the unemployment rate, which measures the number of unemployed as a percentage of the labor force. How does it affect the markets? Put it very simply, a stronger than expected labor report is usually bullish for the Canadian dollar because it means that the economy is in a strong position or is becoming stronger. And on the other side is that the central bank may decide to keep rates where they are for longer, maybe to raise rates instead if they feel the need to. And in turn, the currency appreciates off of the speculation and the strength of the jobs report. For the bond market, bond yields usually you also see a similar reaction to the currency as well, because for the same reasons as the currency, if the central bank, if the jobs market is picking up some steam and the economy is very strong, then the natural reaction is for bond traders or people who may have jumped into bonds during a safe haven period is to go back into the riskier assets such as equities instead, or other riskier assets. But in this scenario, with the stock market, usually what happens with a stronger than expected data is that you can get the market seeing a negative or bearish reaction if data is stronger than expected, because it means, as said, for the other two, the central bank may hold rates where they are for longer or decide to raise rates. And the other point is it also pushes out the expectation of when the first rate cut could happen as well. So there are those varying different things that we have to take into consideration as the base effects in the current circumstance. Usually, stronger than expected report could be bullish if the economy is coming out of a recession, or if the economy is slowly building up steam, and the central bank, the Bank of Canada, isn't looking to tighten monetary policy. So let's keep going then. Previous reports in January 5th, employment by sector showed gains in professional, tech services, healthcare, social assistance. Other services declines were led by wholesale and retail trade and manufacturing as well. Then where is the economy at the moment? Interest rates, of course, remaining unchanged. Inflation rate at 3.4% for the year-on-year compared to 3.1%. Average hourly earnings at 5.7%, ticked up from 5%. GDP quarter-on-quarter annualized for Q3 was at minus 1.1% compared to Q2 of minus 0.2%. Month-on-month at 0.2% for GDP compared to 0%. Employment change last round was 0.1k compared to the prior of 24.9k. The unemployment rate remained unchanged at 5.8%. And then you had the manufacturing PMI, which was at 48.3 compared to 45.4. So the triggers then for the economic release that we have to be aware of what economists see as the high and low estimates for the release. So they see a high estimate of 40k, so that's about a 30k deviation from the forecast, a current median estimate of 15k. And then you have the, there should be a 10. Yes, so that. So yes, sorry. So there should be about a 20k, 25k deviation there. Low estimate with a low estimate of minus 5k and about a 20k deviation. Unemployment rate with a high estimate of 6% and a low estimate of 5.8%. And then sentiment of views from central banks. They had Bank of Canada's Governor Macklem said that we're not forecasting a deep recession and we don't think we need one to get inflation back to target. And then post the rate decision of how the markets had viewed the last rate decision, Canadian money markets saw about a 40% chance of a Bank of Canada rate cut by April, which is down from 65% before the policy announcement. So this is a theme going across not only from the Bank of Canada but other central banks too, that traders are pricing out the first rate cut that would occur from central bank in the Fed, by the ECB, and also the Bank of England as well. So this is why it's important to look at these data points that the central bank focuses on, because the Canadian employment change data could then lead to, of course, if it's stronger than expected, the more jobs that there are that are available, the more spending that there is available too, and in turn can lead to boosting prices in for consumers in the future, which will then in turn make it more difficult for the central bank to rein in inflation and get it towards their 2% goal. Okay, investment bank views then. So TD on the last report, they say the report does little to change the Bank of Canada's thinking, and the overall trend in the Canadian economy has been that of gradual weakness. CIBC said that in Canada, while the household survey jobs figures are subject to a lot of statistical noise and therefore often surprise one way or another, they say that our base case scenario is for another lackluster month. And recent GDP data points to a bit better productivity, and perhaps therefore less need to add workers, while domestic demand remains quite soft. Credit Agricole, they say, according to the latest Bank of Canada minutes, that the Canadian policymakers did not sound too concerned about such developments, highlighting the lagging nature of wages and absorbing capacity of Canadian firms. The bank still noted that it could fuel inflationary pressures if real wages growth continues to outpace productivity in the long run. So not only are we going to be focusing on the headline figure itself, but we're also going to be looking at the average hourly earnings to see how that could have how much of an impact could that have on the Canadian currency when the data does come out. Usually it hasn't had too much of an impact to the data, but can have an influence if the data is more or less in line with expectation for the headline figure and there isn't anything else to go on from. So this was the last release then for the data. Now it was at the same time as the non-farm payrolls release, so the movement was a bit so you can see here from GPCAD that you'd seen a decline, or you'd seen that strengthening from the Canadian dollar, but at that same time you did have a report from the US that was also slightly stronger than what the economists had expected. It came in at 216k. So for the back of this dollar strengthening, you'd also seen some, because the Canadian dollar is there, and based off the dollar itself, it had also seen some appreciation. So again, because the Canadian currency is based off of the dollar, it had also seen an appreciation off of the back of the strength in the of the strength of the US dollar when it had that market reaction. But of course, it's by itself, so there's going to be more focus on the Canadian currency rather than the US. However, the key risk that we do have today on top of the Canadian data is to watch out for what the revised data looks like for CPI in the US. If the revisions if the revisions that we get today are much stronger than they were, maybe representing the whole year for 2023, what that could mean is then that markets and traders could reprice their expectations for when the Federal Reserve might start cutting rates. And in turn, with that, if that does happen, then the dollar could see some strengthening. And then in turn, if the data for Canada isn't that strong or isn't that great, it could give it a little boost, or it could give it provide a bit of a bullish reaction instead. But that's something to just bear in mind and keep in the back of your mind and be aware of the potential risk that could come from the US CPI revision data that will be coming through in less than 4 minutes. So let's go through some of the other stuff. Let's go through the deviations. Somebody had a question about GP CAD, Steven. All right, so let's bring that here to the forefront. Okay, here we go. All right, so with the Canadian employment change data, what we'd seen is that GBP CAD has had the biggest market reaction out of everyone else consistently, with the data barring maybe a couple of reports here or there in the past, but overall consistently it's had the biggest market reaction so far. This is the deviations Google sheet, okay, just showing you how the markets have reacted to economic releases. And the first figure here shows you the initial market reaction going to the wick of the candle on a 1 minute chart. We can see here there was a 36.5 pip move towards the downside. After about 10 minutes of the release being released, then it was still down, but by 9 or about 10 pips. So there was a bit of a reversal. And after about 30 minutes of trading, it was still down by 10. So more or less unchanged from where it was after about 10 minutes of trading. So that's with data that wasn't that great, or didn't really get that big of a deviation. Whereas in the past, when there have been bigger deviations, like as we can see on October, there have been bigger moves. So GP CAD has seen the biggest, alongside CAD JPY as well, have seen the biggest market reactions. Then you're looking at the EuroCAD, the Aussie dollar, Canadian dollar, New Zealand dollar CAD, and then dollar CAD. Okay, so hopefully that kind of clarifies it. So usually, consistently, it's been GP CAD, but last time around it was CAD JPY. So we'll keep an eye on both of those and see how they play out. Right, so we have about less than a minute to go. Hopefully that kind of makes sense. So about 25k on the upside for the deviation, and then about a 20k deviation on the low end for the Canadian employment change data. So I'm going to go quiet about 10 seconds before the release occurs. I'm also going to get TICKSTRIKE up and ready. Right, 10 seconds, and I'm going to go quiet. Okay, so data came in at 37.3K. Forecast was 15K. So near close to the expectation, or the high end expectation for the economists, looking at 40K. All right, it's also with the revisions too for December CPI. See that it's been revised lower to, for the month by the way, lower to 0.2%. So that would explain when you'd seen the initial strength from the data, but now you see that you'd seen that selling momentum that jumped in because of how the dollar also performed too. So the dollar went weaker off of the back of that revision for the December CPI data. So let's see where else we got. The dollar CAD going down, Euro CAD, a bit mixed. CAD JPY is also a little bit mixed too. Okay. What else do we have? That's basically it for the data then. So yes, as I said, you had a stronger than expected Canadian employment change data. However, the revision data that came in for CPI in the US then rocked it and then pulled it back to a move towards the downside. And that was quite sharp, so it's quite quick with that reaction there. Now, that concludes the MACROACE live stream for now. But one thing to also note is with FinancialJuice is we currently have a New Year offer at the moment. So you can get 92% off our New Year 92 deal. So you can get FinancialJuice instead of £99 a month, $99 a month. You can get it for $99 for 1 year. So let me just grab that little link for you to have a little look at, for you guys to have a little peek. Okay, that is the link there for you to have a little look at. So again, as said, you get 92% off with the data, with the FJ Pro for a year. So instead of paying over $1,000 a year, you pay $99 with the New Year 92 code, which I'll post in the chat for you here as well. Okay, that's there. Now, first thing to always make sure to do is to understand that if you haven't subscribed or if you haven't signed up to FinancialJuice, then and you want to go for a subscription, make sure you have created an account on FinancialJuice. Then once you've created your account and you've verified your account through your email, then go back, use a link that's been provided in the chat, and then use a promo code to get FinancialJuice for a year for $99 rather than over $1,000. So that's that there. So if you never come across a live voice and text service, then just give you a quick lowdown of what it is. A live voice and text service keeps you up to date with what's going on within the markets, what's happening with the keeping up to date with economic releases, if there is central bank speak that is going on, or if there's important data that's going to be released with today with inflation. Then you can have a look at that all in one place, okay, which is here on FinancialJuice. So here on FinancialJuice, we have our live voice here, okay, which is there. You should be able to see me scrolling up and down. All right, that's it there. And then in the center, we have our news headlines, our news feed, text headlines. On the left-hand side, you have your economic calendar for the week ahead. In the top here, you have your need to know market risk of what's happened in the session, or what are the upcoming risks that are present or could come about for the market or for the trading session. Okay, so it's all in one place. Great tool for day traders to use. If that's your thing, that's what FinancialJuice is made for. Keeping day traders up to date with what's going on within markets, what's going on geopolitically, all in one place. All right, so that is FinancialJuice, and I've put the link there for you to the offer. And yeah, and for those of you who wanted to get access to the MACROACE deviations or Google Sheet, then all you got to do is subscribe to the mailing list, which is here. Now, if you subscribe to the mailing list, then you get access not only to the ranges and deviations Google Sheet that I'd shown to you guys, but you also get an email every Monday to give you a short rundown of what to expect in the US and European sessions, and Asia as well, all in one place. It's quite short. It's very brief in the review that I give to you guys in an email, but it's supposed to act as a refresher. So it's not chock-a-block full of so much detail, because I give you guys the detail in the streams here of what to expect and the sentiment and things to be aware of. Like today, we had the we had the seasonal adjustments to CPI data. Okay, so the link is there for you to join that there. Live Action says, "Do it, guys. They're great. Put me on top ahead of most numerous times in the past weeks alone." No, they're not paying me to say this. You're not supposed to say that. Now they're not going to believe you. But yeah, so but thank you for that for your comment there. But yeah, so that is it. Next week we have US CPI data. Okay, looking at January, and that will help to determine whether the Federal Reserve does take a cut in May or if they push it out further. So you can, as said, you can join me live on next Tuesday in the MACROACE main list in the email that I send on a Monday, once a week. In the morning, you'll get the link to the stream there, okay, and the ranges deviations. All right, I will see you guys then. For now, enjoy your weekend. Have a great Friday, and thank you very much. Take care.